It's time for Yahoo Finance's Market Minute. Stocks falling after the February jobs report did come in slightly weaker than expected. Broadcom shares are higher as its outlook signals robust demand for AI chips. Revenue in Broadcom's artificial intelligence unit rose 77% year over year in its fiscal first quarter. The CEO saying customers continue to, quote, invest aggressively in next-gen AI models. And Walgreens shares rising after finalizing a $10 billion deal with Sycamore Partners to take the drugstore chain private. After 4 months of negotiations, shareholders will get $11.45 per share in cash upon completion of that sale. And Costco shares under pressure following a mixed report in its second quarter. Retailer warning about the looming threat of tariffs. The CEO saying, quote, it is difficult to predict the impact of tariffs, but the goal is to limit the impact on the consumer. That's your Yahoo Finance Market Minute. For more on what's trending on Yahoo Finance, scan the QR code below to track the best and worst performing stocks of the session.
Welcome to Wealth. I'm Madison Mills, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts giving you the resources, tools, tips, and tricks to grow your money. On today's show, Portfolio Checkup, we'll discuss why now is a good time for investors to know what they own and why they own it. We'll also dive into the latest jobs report and talk to an economist from Indeed about the best ways you can set yourself up for success in your job search. Plus, Retail Playbook. It's been a couple of weeks filled with retail earnings results. We'll discuss which stocks in the sector could fit into your portfolio. But first, let's take a look at some of the market action 90 minutes into the trading day. We still got stocks moving to the downside following that February jobs report. As we wrap up a volatile week on Wall Street, you've got your S&P 500 down about 0.4%, similar to your tech-heavy NASDAQ, also down about 0.4%. Joining me now to discuss, we've got Brian Mulberry. He is Zacks Investment Management Client Portfolio Manager. Great to have you on. So I know you say that now is the time for investors to know what they own and why they own it. Does that mean that all of this volatility from the past week is just noise in your view, that the base case is still the same?
Well, a lot of the volatility is trying to answer the question, is this really a growth scare, or is it just simply that there's some uncertainty on the path for future growth? We know that we got the Atlanta Fed saying the GDP now number down as much as 3% for the first quarter, and that's kind of a shocking thing. But a lot of that has to do with the variability of outcomes when it comes to trade. Domestically, we're still seeing a very high level of CapEx investment plan, but that takes time to come back into the marketplace. And so what we have in the intermediate period right now in the short term is a lot of outcomes that could be different, and the market doesn't like that type of uncertainty. So along those lines, we're seeing a lot of people rebalance their portfolios. I think de-risking. There's a lot of people that have been involved with the Magnificent Seven now turning into the Lag Seven, and they're wanting to reevaluate what risk looks like in their portfolio. So we're definitely seeing people come away from the more growthier but also riskier sectors of the market like consumer discretionary and technology and look for better valuations. And you can find those in places like healthcare and financials at this point in time, where you still see really strong balance sheets, very good companies that have strong growth potential, just not the same type of volatility that you're finding in those other growthier types of sectors of this market.
And just curious what you're making of today's market action, in particular after that jobs print came in nearly in line with estimates. We added 151,000. We were looking for 160,000, but that's pretty close. We had a slight uptick in unemployment as well, but we're seeing more selling than we saw initially off the back of that print. What does that tell you about how the market is viewing risks to the economy right now?
Well, at the moment, the longer-term risk is higher for longer interest rates. And so what this jobs report told us is that things are still pretty much okay when it comes to that soft landing picture. So I think it's really more of that vision that rates aren't going to go lower anytime soon. We know that there's a Fed meeting later this month, and they're likely to take no action. In fact, there is a picture where we could see rate reductions later in June and July, but we're still in the camp of only 1 or 2 interest rate reductions. And that means that the cost cost of capital stays a little bit higher, and that those companies are going to have to deal with that. That does impact that rate of growth for some of these companies as well. So again, coming back into a better valuation model where you can look inside of healthcare and find an average PE of around 18 to 20 versus the 30-ish that you're getting from most NASDAQ 100 companies, or even in the banking sector and financials, where those PEs are closer to 14 to 15 and still see good growth metrics. That seems like an appropriate de-risking of a portfolio at this moment in time.
We did see a bit of selling in financials this week. Are you concerned at all that we're seeing a little bit of a recessionary trade that could continue to be a laggard for the financial stocks?
No, in fact, what we're seeing with the 10-year Treasury down around 50 basis points on a year-to-date basis is sparking a wave of refinancing. And so for those banks that have a really large portfolio in the mortgage book, they're actually, standing to do better in terms of that fee revenue over the next quarter or so. And if we do get a wave of deregulation, we could see a parabolic growth rate for some of these financial names as well. So in the short term, yes, a little bit of pain. But if your main concern is tariffs, a lot of these multinational banks are kind of immune because they're just simply facilitating the financing of these goods and services. They don't really have a higher cost of doing business when it comes to these tariffs being implemented. So if that's your main concern, this is a little bit of a tariff-proof sector where you can go and hide out in.
So then what do you make of the action that we're seeing in these financial names? I mean, financials right now are on track to be the second worst performer in the S&P over the last 5 days, and you've got JP Morgan down 9% for the week at the moment. I know that's one of your picks. Do you want to talk to us about your bull case there?
Yeah, absolutely. A little bit of a sell the news type of a rotation right now in financials, but still one of the biggest banks on the planet that's going to be facilitating a lot of business going forward. And with some deregulation and a better environment in terms of, lower rates on the 10-year Treasury, we could actually see more M&A business. That's obviously good for their investment bank segment. And also we could anticipate later this year a better IPO market that they'll benefit from as well. So we feel like this is a very high quality name that has a strong dividend yield at the same time, so you can get paid while you wait out some of this volatility. And there's every reason to believe that they're going to bounce back from this recent performance.
All right, Brian, we got to leave it there. Thanks so much for joining us this morning.
Thank you.
It's now time for some of today's trending tickers. Scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. Joining me now is co-host of Market Domination, Julie Hyman. And Julie, first up, we are going to talk about Intuitive Machines sinking here after ending its lunar lander mission early after a faulty landing. And this is the second setback here after a similar problem that the company had last year. I believe the stock dip here, you can see it's down about 20%. That is the worst dip that we've seen here for Intuitive Machines since February of 2024. What else are you looking at?
So the stock is down today. It was down very sharply yesterday and kept being halted because of volatility. Yesterday is the day that the company's Athena lander landed on the surface of the moon. What happened the first time that it had a lander land on the moon is it sort of fell over sideways. The landing had some issues, and so it wasn't able to complete the mission. So there were a lot of hopes riding on this second mission. It had a successful landing, but there were a lot of questions yesterday about kind of the status of the lander once it had landed. And indeed, the company came out today and said, basically, it didn't land the way it was supposed to. So they said in a statement, the direction of the sun, the orientation of the solar panels, extreme cold temperatures in the crater where it landed, they said they don't expect it to recharge. It was able to do a couple of the things there that it was supposed to do, but ultimately one of its missions was to go out and collect dirt samples to try and find evidence of water, right. And it wasn't able to go out and do that. Right. So, this is obviously a setback. There are some analysts who are saying they want to wait for more information. There's at least one analyst who said the reaction is overdone. Regardless, it's a big reaction.
Yeah, it certainly is a big reaction. And if I'm remembering from conversations with other investors in the space that we have had, this is one of the ways for retail investors to be able to play space exploration. So potentially seeing some pain in that trade today. But another stock that we want to talk about together here, Smith & Wesson shares tumbling on the back of those weak third quarter sales results here, reporting those weaker than expected third quarter results and saying full year revenue is expected to be at the lower end of its previously provided targeted range here. I wonder what's driving some of the weak demand that we are seeing for them.
So what's interesting is Smith & Wesson, a gun maker, subject to the same consumer spending trends that any consumer product would be subject to. And so the company talking about buyers sort of migrating to lower end guns, that's something that's been affecting them. That forecast that you mentioned for the full year is a 5 to 10% decrease from 2024. And they're now saying it's going to be more like 10% than 5% because of, in part, some of the macroeconomic trends that they are watching. We did see the national background check data for February show a decline in gun sales overall. So, it seems like they are subject to some of those macro trends that are affecting the industry. One interesting thing here, they make the guns in the U.S. So there was a question on the call about tariffs. It doesn't seem like that they are that affected by tariffs. Maybe some of their components come from abroad, but they are mostly insulated from that effect. Nonetheless, also it bears mentioning that gun sales tend to do better in Democratic administrations versus Republican ones, and especially leading up to elections where Democrats end up being successful. And that's because there is sort of less concern about regulations changing to limit the sales of guns. So that's a trend that we have tended to see in the past. We'll see how that plays out for the rest of the year.
I would not have known that, but that makes sense that you see that trend. And I would be curious to learn more about the income level of their consumer too, just given that if they're not going to be impacted by tariffs, maybe it's also a good indicator of kind of which income groups are struggling just due to the broader macro environment.
Right. They did talk about some of their higher end products as well, that some of them are holding up relatively well. But again, we'll see how that progresses over the course of the year.
All right, Julie, thank you so much for joining us. Always appreciate chatting with you. Well, that latest jobs report came in slightly softer than anticipated, with 151,000 jobs added in the month of February, just shy of the 160,000 estimate. The 3-month average job gains remain between the averages saw in 2019 and 2023. But our next guest says trouble could be brewing. With more, I want to bring in Corey Stahl. He is Indeed's hiring lab economist. Corey, great to have you on here. Just talk to me about your reaction to this jobs report. And one thing I've been looking at is the underemployment rate as well. Did you see any weakness under the hood of this data print that people who are looking for jobs right now should be worried about?
Yeah, thanks for having me, Madison. Certainly, yeah, I mean, obviously, headline number, pretty good, 151,000 jobs. Surely isn't something to sneeze at. The unemployment rate ticked up a little bit, but still low there. But as we start to look under the hood, obviously the big number today that everybody was watching was federal employment. We saw federal jobs shed about 10,000 jobs in February. But I think even as we start to look beyond that, you talk about underemployment, but we also look at some areas like labor force participation rate. We've seen that the prime age participation has been dropping and has been trending down, right? So in an economy and in a labor market where we have some potential impacts starting to occur due to immigration restrictions, and now you're seeing younger workers not participating at the same rates that they were, in the last year or two. That's definitely concerning as we look forward. The other thing that stood out to me too is we also saw a spike in people working part-time for economic reasons this month. And that's something that's been trending up now for a little while. And so I think as we start to look at those, for job seekers, there are certainly some reasons to be concerned, especially if you're working in software development, IT, and some of these areas of the economy that have fewer job opportunities now than there were before the pandemic.
Yeah, help me understand just how hard it is for job seekers right now, as we have seen hiring declining. It seems like if you have a job right now and you're not trying to get out of it, you're kind of in an okay position. But if you're looking, how big of a hurdle is it to find a job? How long is it taking?
Yeah, I think the real interesting and challenging thing here is that it really depends, right, on what type of work it is you're doing. Once again, we saw a report today where 45% of the jobs added in the private sector came from healthcare. So if you're a job seeker looking in healthcare, we still see a lot of opportunities there, a lot of hiring there. But if you're starting to look more in some of these like IT type roles, marketing, data analytics, these types of things have pulled back a lot in the last couple of years. And software development, just as an example, on the Indeed platform, there's now fewer, we're down more than 30% in job postings for software developers. So again, right now, as you're seeing this, there are some areas of the labor market that are doing better than others. Really, it's a bifurcated labor market that, as I said, your experience with it is going to depend on the type of work it is that you're doing.
And I also want to end on specific tips for those job searchers right now. I know that one of your tips is to work on your resume as part of that search. Talk to me about what people can do to make their resume stand out in this market.
Yeah, I mean, this is the age-old advice, right? Like making sure that your resume is tailored to the job is going to be key, especially as we're moving into the era of applicant tracking systems. In other words, these are programs that hiring managers and companies can use to screen and filter and make sure your resume is matching the job. And so as a job seeker, that means that you need to be taking the steps to make sure your resume does match the job. And there are a lot of great ways to do that, even with the rise in tools like generative AI, and ChatGPT, being able to, bounce ideas off of these types of tools and say, okay, like where am I maybe missing on this job? How can I kind of tailor and match this up? I think is key. And then I think just additionally, as we talked about, there's a lot of challenges right now, especially in some areas. Don't get burned out. Keep applying and keep trying to, again, tailor and understand, what employers are looking for.
I think that's very good advice in terms of making sure that you are being active but not burning yourself out on the job search. Corey, thanks so much for joining us.
Thank you for having me.
Coming up, rising egg prices are an even bigger pain for Costco than you might think. We're going to dive into why. Plus, we'll give you some retail stock superlatives with an analyst. All of that next on Wealth.
We're not really seeing any change in what we've seen around our members over the last really few quarters. We believe that the member is probably as much focused now on quality, value, and newness as they have been for quite some time. But they are still showing that willingness to spend, but they're being very choiceful where they're spending their dollars. And we think that's likely to continue and maybe even become more choiceful as the impact of some return of inflation and the potential impact of tariffs could flow through as well.
That was Costco CFO Gary Millerchip talking about the consumer on the retailer's second quarter earnings call. Here to dig into the results, we've got Yahoo Finance senior reporter Brooke DePalma. Brooke, I know you've been all over not only this retailer, but so many of the retailers this week. What are your biggest takeaways from Costco?
Right. Well, Costco certainly not immune here to what we're hearing about these tariffs. Now, Costco did post mixed results. And within that call, they also noted that they incurred an increased cost in their supply chain as they really look to get ahead of the potential risk around tariffs. Now, for some context here, 1/3 of its sales in the U.S. are imported from other countries, and less than a half of that comes from China, Mexico, and Canada. Now, despite this cautionary commentary that we're hearing from executives about tariffs and the looming impact that it could have on both its business and the consumer, Costco did put up a pretty strong quarter when it comes to same-store sales growth. It did beat the street's expectations, coming in at an increase of 6.8% and double-digit growth from discretionary items like gold, jewelry, gift cards, toys, housewares, appliances, sporting goods, those as well as home furnishing and small electronics. That's what really boosted that same-store sales growth. Now, keep in mind, these quarterly results are a look back, and so this was the holiday, and so we know that consumers obviously get these sort of items during the holiday to gift, and so that did end up boosting their second quarter same-store sales results. Worth noting here as well that despite this setback that we're seeing in shares this morning because of this cautionary tale, Costco, BJ's, Walmart, all are outperforming the S&P 500 so far year to date. And it really continues this notion that we continue to hear about consumers looking for the best value, the best bang for their buck. And that's why perhaps these shares are outperforming the S&P 500 so far year to date.
And it's fascinating that inflation and the broader macro environment, that's not just something that impacts Costco consumers who are experiencing the inflation, but Costco also has the inflation with the food that they have to buy. Can you walk me through that?
Yeah, exactly. So these items that they sell, these items that consumers really turn to, like meat, like bakery items, that's where we saw fresh food inflation really go higher this past month. Now, ground beef is something that consumers are turning to. They're looking for a cheaper alternative to perhaps those higher ticketed steaks. Other inflation that the company is still seeing is cocoa, coffee, cheese, and corn, things that we've heard before. But bakery being driven by one specific item. CFO Gary Millerchip weighed on that on the call.
It's really eggs that's causing the major pain there. It's kind of it's offsetting, unfortunately, just the percentage growth that we've seen in eggs has far outweighed the deflationary situation on those other items.
Now, deflationary items include sugar, butter, and flour. But of course, the big item that we've been hearing about all year so far is those eggs. We know that back in January, they hit a record high price of $4.95. And that certainly is weighing on Costco, specifically their bakery department. But also, they didn't really speak to that notion of just seeing consumers really stockpile, really flock to eggs, for lack of a better word, earlier this year. But we do know that is driving their fresh foods inflation higher this past quarter.
And I know that they also recently had that limit put on their egg purchases for customers as well. So certainly dealing with the price of eggs across a lot of facets of the business. Brooke, thank you so much for joining us. Appreciate it as always. Well, President Trump's tariffs roiled markets this week, and the ever-changing trade policy poses issues to a lot of retailers scrambling to navigate more complex supply chains, higher costs, and challenged consumer markets. As a result, investors shifting into risk-off mode. So here to discuss the impact on retailers, we've got Simeon Siegel. He is BMO Capital Markets Managing Director. Simeon, we're going to talk about some individual retailers in the space, but first just tell me how you're viewing the totality of earnings prints from retailers this quarter and what you're expecting in terms of the impact from policy.
Yes, hey, man, great to see you. So I think that right now you're in, Brooke said it perfectly, this notion of risk off because of what things are going with eggs translates into the rest of consumer. But I think the most interesting dynamic that we're seeing from an investor is this risk off simply because the market is very hard. And that sounds very simplistic. But right now you're watching a lot of people look at these companies and see a mismatch between performance and what is going on. And so for most of my investor conversations, people are just nervous to make a bet. And they would much rather pay up for something they perceive to be quality than actually start looking down in the dumps, so to speak, for a value dislocation. And normally you have people that chase growth and momentum and are willing to pay up, but you also have a strong value investor that's willing to go and find underappreciated opportunities. I can tell you from my conversation, there are not many people willing to pick up the phone for a value opportunity right now.
That's really interesting and it plays into our broader conversation, Simeon. I want to get into some retail superlatives with you for this moment of such volatility. Some of those perceived safer names for investors, including some of your most comfortable picks. What are some of those stocks?
Yeah, so it's funny, right? Because I'm supposed to be intellectually honest. I'm supposed to look at things and say things are supposed to have an intrinsic value. And on the other hand, we can see, you were just talking about Costco. Look where Costco is trading. We talk about TJX in my world. Look at where that's trading. Like there's companies, Planet Fitness, which are just excellent businesses. They're businesses that'll continue to compound. They're businesses that honestly shouldn't have much in the way of surprises vis-a-vis their business. But you and I need to be okay paying for effectively valuations that we have never seen. And so those are the businesses on the, let's call it the right side of my barbell, where I'm just looking for good compounding businesses, where if I'm thinking about the risk framework, if I'm using your superlatives, I have businesses that I'm taking risk on the numbers, on the business, and I have businesses I'm taking risk on the valuation. TJX, Planet Fitness, I'm not really worried about the business. I would have to be taking a risk on the numbers. So that's my right side. Good, expensive for a reason companies, TJX, Planet Fitness. The other side, so if I'm looking at businesses that I think are less risk to the multiples because they're so heavily compressed, but I'm willing to take the risk on the business, I think there's some really interesting opportunity. I think there's a host of those. And I think the number one for us right now is Capri, which owns Michael Kors, Versace, and Jimmy Choo, where I think there's interesting balance sheet opportunities, and I think there's interesting company fix opportunities. But I will say, right now, there's just not that much of an appetite for it, which again begs the Buffett question of at what point are we supposed to be fearful and what point are we supposed to be greedy?
And I'm fascinated in those picks because you can dive into each and get a completely different story about the state of the economy and the state of the consumer. For the TJX and Planet Fitness picks in particular, is there a concern to be had about that mid to lower tier consumer who might have to trade out of those names if the economy slows further?
So I think it's an excellent question. I'm glad you brought it up. If you look at the average revenue, so if you look at We're almost done. It's ironic. We're in March, but we're still reporting Q4 earnings from last year. We're almost done getting the Q4 earnings. If you look at the companies that reported Q4 earnings on the consumer discretionary side, Staples is a little bit different, but on the discretionary side, not large. The average company is actually posting revenue growth of around 5%. That's really good, right? And then we can talk about price versus units, but that's actually, the consumer is still spending. And so there's this big, broad boogeyman fear of macro and tariffs, which I'm sure if we want to probe into, I've used there too, which we can talk about. But companies are actually still outperforming, or they're performing nicely, and they're doing it on healthy gross margins. And so we have this rhetoric of where are people shopping, which type of people are shopping. But what we're actually seeing, I think, is we're seeing market share conversations. We're seeing winners and losers within each group. And so that's one point that I think we need to stress, that I do think the underlying trends of businesses are actually healthier than they're seeing. And I think the second Venn diagram bubble that I would throw out, every company, not every company, most companies that reported that saw their stocks get hit the most recent weeks, they didn't actually complain about their results. They were worrying and they were cautioning about the guidance.
Right.
Is that going to be conservative? Is it not? Is another question. But so to your point about TJ and Planet, I think that TJX, more so than maybe other off-pricers, actually has a very diverse income strata. It's not just discounting. TJ is not optimizing for price. It's optimizing for value. It's trying to give a great offer, and it gives brands a good place to sell their products. And so I think even in the scenario that you outlined, I think TJX still benefits. Again, I think that I would caution against saying the lower income consumer is not shopping. I don't know if I would adhere to that. But even within that scenario, I think TJ still wins.
So, Simeon, you made me think of something I've just been personally wondering about, which is who is best positioned to handle the impact of tariffs. And I've wondered if we're going to see a return to favor for some of the big box retailers that have these iron balance sheets, the likes of Walmart and Target, which obviously are struggling off of their earnings. But when you compare to some of these direct-to-consumer brands that have grown in popularity, kind of the Instagram companies, are the big box retailers just better positioned to handle the overwhelming uncertainty that's coming from policy right now?
So I think it's a beautiful question. If I can reframe it slightly and say, I think what you're asking is, are the healthier companies better suited to be healthy? And the answer obviously is yes. I've completely oversimplified your question and made it sound silly. It's not what I mean to do.
Yeah.
But I think the point is tariffs. And I think you're getting at a very important point. What are tariffs, right? Ignoring and removing, and I'm not an economist, and I'm sure economists will tell me I'm wrong, and they're much smarter than I am, so we'll take that as the caveat. But what are tariffs? Tariffs are a cost input that goes up. The same way that cotton is a cost input that can go up, wage can go up, supply chain, shipping and handling can go up. When a company faces a cost input that goes up, they deal with it. And the companies that are best suited to deal with it are the companies that, one, have the best brand equity and can therefore take the most pricing to try and offset it, because that's the easiest way to do it if you're able to. The other scenario is you find other savings. You cut other costs. And so what that means is it's who can deal with costs going up. Well, the best situated companies, to your point, having a fortress balance sheet helps you work your way through it. But you need to be able to absorb the cost. You need to be able to figure out a way to pass it on or save elsewhere. That just means, are you a good business? The problem, in my opinion, with tariffs right now are dramatic. It's the uncertainty of the tariff, dramatically more than the severity of the tariff. Companies don't know what problem they're trying to fix. Are they supposed to take their China supply chain and move it to Mexico, as they may have done a few years ago? Well, that wouldn't have worked. Are they supposed to move it to another country? And I think that this two-step, this inability to say, here is the problem, I know the problem I'm trying to fix, I think that's what's creating all the uncertainty and the volatility. Once they know what problem they need to address, their companies, the best companies, will be able to address it. Others will feel pain. I don't mean to belittle it, but at least they'll know how to proceed.
Yeah, I really love the breakdown. Is a healthy company healthy? And the answer is yes. Simeon, thank you so much for joining us and breaking all of that down. Appreciate it.
Great to see you.
Coming up, mortgage rates are getting lower. I'm going to speak with a real estate broker about what this means for the housing market, coming up on Wealth. Mortgage rates fell to another 2025 low as tariff and growth fears sent Treasury yields lower. Mortgage applications increasing in turn, volume jumping over 20% from the week prior. Freddie Mac's chief economist saying in a statement, quote, "The decline in rates increases prospective homebuyers' purchasing power and should provide a strong incentive to make a move." Joining me now on the housing market and more, we've got Noble Black, Douglas Elliman, associate broker. Noble, it's great to have you in studio.
Thanks for having me.
the national housing market right now. I think people have a lot of questions. They're feeling blocked out of the market, as we were discussing. How are you looking at the market right now?
Well, with excitement, because it's definitely good for us, right? I mean, it has really been a great market starting back in July and August, which is usually slow for us. But when people first really being confident that there was a rate cut coming, we started seeing, especially the wealthy, start coming back into the market. Not that they needed to finance, but they just felt like there were good winds at their back. And it's really continued since then. So we're very excited, certainly for New York, but nationally, I think people are looking at a very strong market for at least the next, I think people are saying 12 to 18 months.
And how are you thinking about the Federal Reserve and the kind of potential that we may not get as many rate cuts this year as we previously might have anticipated? How does that impact and interplay with activity on the housing market?
As of right now, I think people are baking that in. Certainly back in the fall, we were thinking like this is going to be amazing because we had the half point and then we had the other quarter point. We were expecting another train that looks like it's been pushed out, right? I think the surprise for us is that we were busy leading up to the election, which we're usually not. And then after the election, it really continued. And I think for a lot of people, not to get into politics, but I think for a lot of people, even if they weren't happy with the result of the election, a lot, especially the wealthy, felt like, okay, there's going to be lower taxes. They're going to make a lot of money, right? And I think that's a lot of people's mindset. They feel like also values are not going down. And let's be frank, rates have been high for 2 years basically. So life happens, divorce, job changes, marriage. People are absorbing the change and they're coming back into the market.
And since you mentioned, and I am wondering about the Trump administration's focus on the 10-year yield and keeping that low, which is obviously tied to mortgage rates. We've seen record-breaking drop in the 10-year yield just in the last 2 months. If that continues, how much does that unlock activity as well?
I think a lot. I mean, I think we've got strong activity, but I think if we can get mortgage rates continuing to go down dramatically, you're going to see a lot more people coming back into the market. Because especially for, nationally speaking, but certainly even in New York, if you're talking about the entry level, those people are still very rate conscious, right? And for New York, that's kind of, let's call it below $1.5 million or $2 million. Nationally, that's higher prices. But those people are very much still looking at what their mortgage payments are going to be. And those are the people right now that are the least likely to be coming into the market. They're slowly coming back in. But if we can get rates meaningfully down, we've got a whole other group of supply that's coming in that'll just build on the market.
And I wonder if I can just get your advice on this. I talk about this with friends all the time. We were talking about it a little bit before, but just this feeling amongst younger potential first-time home buyers that it's just out of reach. So why even kind of work towards it? Why even kind of be saving for it instead of just keeping your money in the stock market, for example? Why does real estate still make sense for some people as an investment?
It's frustrating, right? And especially for young people, it can be kind of overwhelming. Look, I mean, at the end of the day, it's a huge source of building wealth, and I think that's going to continue to be the case. So whether you're, starting small and then you're working your way up from that, whether you have to, beg and borrow from neighbors and friends and whatever you can do to get into the market, ultimately you're going to own something that I think is going to appreciate. It's a nest egg that you're building, and I don't see that changing anytime, certainly in the next medium 5-10 years. I just think that's the way that our country still operates. And I think for young people, again, start small, save that, but it's for savings, and it's the best path that we know of to building wealth.
Yeah, and I know it varies so much city by city, but how much do you generally tell people they need to have saved before they can approach the home buying
conversation? More than
they
think, probably. It's in New York, it's really tough, right? The prices here, and I specialize in New York and the Hamptons, and the prices are really, really high, especially for first-time buyers. It's rare that we see somebody that is totally on their own, totally self-made, that's buying something for the first time, without parental help or without a spouse, anything like that. It's hard to build that nest egg. But again, start small. You don't have to live in a prime location. You don't have to be in Manhattan. You can go to one of the suburbs, and then again, work your way up to that. If you take a loan from your parents and then pay them back, obviously most people don't have that option, but whatever you can do to get into the market long term, it's going to come back to you in terms of a good investment.
Right. I'm a Manhattan girl, so it's hard for me to imagine that, but I take your point seriously. Lastly, I just want to ask, the firm obviously featured in Selling the City on Netflix, and I wonder, has that impacted activity at all? Has it impacted the type of clientele that you're seeking? What's been the biggest change?
I think it's certainly, the series is well received, and it's certainly gotten our firm's name out in front of a lot of people. My business is so dramatically different from the reality show business. Most of my clients are not people that want to be public. I mean, they're bold-faced names, but they don't want their private lives out there.
Right.
But they may watch the show, right? So it's still very entertaining. So, I think it's been something that's given a lot of people a lot of fun. And again, another show to binge watch. I don't know that it's really changed our business much, but certainly been some good TV for some people.
Absolutely. All right. Well, thank you so much for joining us.
Absolutely.
We'll really
Thanks for having
appreciate
me.
you coming in. Thank you so much. We'll have to have you back soon. Well, coming up, women in the U.S. are expected to be in charge of $30 trillion in wealth by 2030. We're going to discuss how women can maximize their economic power next. Let's get a quick check on the markets. Really want to point out some key levels here. The NASDAQ officially entering into correction territory, down 10% from its prior high about 3 months ago. And you're seeing the selling continuing today off the back of that key jobs print this morning. Taking a look at the S&P intraday, down just about 1%, but this continues the selling activity and the volatility that we have seen continuing throughout the week. The S&P 500 down about 4.5% just over the past week here, and obviously the tech-heavy NASDAQ leading those losses here when it comes to the market volatility that we have been seeing. That jobs report this morning coming in close to where we thought it was going to be, coming in at 151,000 versus 160,000 jobs, a slight uptick in unemployment. But initially, the market reaction off of the print was to the upside. We saw a little bit of that green that you can see in this chart behind me here before we saw more of the selling coming in here. Most of the trading activity does happen towards the final half hour of the trading day, so we'll see how these stocks end for the week. But right now, we are on track for about 5% of losses on the week. Well, women are set to control $30 trillion of wealth by 2030, marking 38% of all investable assets. That's according to Bank of America. Now, that's up from $7.3 trillion that women controlled just a decade ago. My next guest is here with strategies on how women can maximize their economic power. Joining me is Jessica Caruso, Mercer Advisor Executive Managing Director. It's great to have you on. Just give me the context here. How is this great wealth transfer happening, and what can you tell us about what this is looking like?
Yeah, thanks, Madison. I think, first of all, women are controlling more and more wealth, and what the strategy and financial plan and investments should look like for every woman is really different. I think at the end of the day, money is just a tool or a resource that helps us achieve each of our individual goals, and it's a resource that should be aligned with what's important to us. And with tomorrow being International Women's Day, I think women are particularly good at thinking about their financial plans that way, not just as a competition for who can be the best stock jockey or have the best investment portfolio to brag about on the golf course, but to really think about a financial strategy as a way to empower the things that are important to us. And so it's really exciting to see women step more and more into that wealth transfer and to have more power and resources here in the economy.
And what do you think is the single biggest financial decision that women are making and can make in their lifetimes to increase their economic power?
Yeah, I think where I would start is that women really need to have a plan and build that unique personal plan. I talked about how women do a good job of kind of aligning their capital with their vision for the future. And I think building that unique personal plan can really help, and having clarity alongside a team, having the right advisor team in place to really help you develop a plan that's in your best interest. So I think number one piece of advice would be to get a plan in place and have some holistic support around what that plan looks like. So that would include things like a financial planner. I would personally recommend a fiduciary certified financial planner, and also making sure that you're, as a part of that plan, integrating all these different aspects of your wealth, not just investments, but taxes, estate planning, risk management, really looking at the whole plan and getting clarity on where you want to go.
And talk me through how women should be thinking about whether or not they need to outsource their financial advisement versus doing it themselves, because obviously it's a cost saver if you can do it yourself, especially given the percentage fees that some advisors take on your investment returns over the course of your lifetime. How are you thinking about that?
Yeah, I mean, I'm probably a little biased as a financial advisor myself, but I really think it can be quite valuable to have someone manage some of these decisions for you and just be a coach to really partner with you alongside this. I personally am a certified financial planner, but I actually recently sat down with my partner and one of our internal advisors here at Mercer Advisors and said, hey, it might actually help me to look at all of my spending and do that with a separate third party and help me identify a few things I'm missing. I literally do this for a living, but actually this woman, her name's Sarah, my advisor, sat down with me and said, Jess, did you realize that your IRA isn't aligned in the same way as this other account over here? And let's sit down with your husband and look at spending. And some of that ability to have someone as just this third party, she actually found things that I had missed. And it was really helpful for me to look back at that and think, hey, I paid her a fee, but actually in relation to that fee, the compounding effect of some of those really small things that she identified for me over time absolutely paid for that fee 10 times over.
Yeah.
So I would really recommend that everyone at least consider what it looks like and sit down with someone and understand what advice might look like.
Yeah, that makes a ton of sense, Jessica. In our final 30 seconds, what's the biggest mistake you see women making that you want to warn us about?
Yeah, I think biggest mistake for me, I think there's a few, but one that comes to mind, first of all, is just this idea of being a little too scared or conservative. We know that men tend to be a little bit more aggressive with their finances and women are more conservative. I think in many cases that actually helps us, but sometimes it can hurt us by not wanting to take some risk, not wanting to be aggressive enough in their portfolios, and really thinking account by account, what is the plan and purpose for each of these accounts? And if there is a long-term goal there, am I aggressive enough? Am I pushing hard enough to really achieve my goals? We know women live longer. We have to plan for longevity. So we need a little risk in our portfolio that sometimes women miss.
All right, Jessica, thanks so much for joining us. Really appreciate it.
Absolutely. Thank you, Madison.
Let's take a quick look at the market. Stocks continuing to fall after that volatile week on Wall Street. You've got your S&P down over 1%, your tech-heavy NASDAQ in correction territory, down about 1.5%. Next up, President Trump's potential plans to cut workers from the IRS sparking concern, not just from Democrats. That's coming up next on Wealth. Quick programming note, tune into Wealth next week for our special tax week. We'll cover everything you need to know ahead of the April 15th tax deadline and what you can still do before you file. Monday, we'll talk about the IRS's crackdown on side hustles, breaking down new rules you need to know and tips to help you properly report. Tuesday, everything you need to know about your refund, from how to check it, how to make the most of it as well. And Wednesday, we'll explain what happens if you make a mistake while filing and go through steps you can take to fix it before it costs you. Thursday, we'll break down what's fact and fiction when it comes to the IRS. And on Friday, we'll have last-minute moves to lower your 2024 tax bill. Don't miss it all next week, right here on Wealth. And according to the International Revenue Service, Americans file over 150 million tax returns every year. But earlier this week, the New York Times reported that as many as half of the IRS's 90,000 workers could be let go as part of President Trump's attempt to trim federal spending. Democrats are not the only ones with concerns. Here with more, we've got Yahoo Finance senior reporter Jordan Weissman. Jordan, tell us about who's raising these concerns.
Yeah, so you're seeing sort of a lot of warnings coming from a bipartisan group of the IRS's former leaders. You've got Republican and Democratic ex-commissioners saying that this could be catastrophic for the agency. Chuck Rettig, who was Donald Trump's hand-picked IRS commissioner during his first term, told me that it would put every basic function, internal and external, at risk. That it might not be able to just do handle basic compliance and processing work. So again, this is becoming an across the aisle issue, at least outside of Congress. Inside of Congress, you're not hearing much from Republicans yet. They're sort of letting the administration do what it wants at the moment.
And talk to me about the obvious fact that we're in the middle of tax season. Is there any concern about how these layoffs of federal workers are going to impact the ability for Americans' taxes to be checked and for refunds to go out?
Well, so the big issue there is that the IRS started laying off about 7,000 workers in February, and that could have an impact. Former officials were warning that, that could leave them short-staffed in ways that are hard to predict. This huge, 45,000 person cut, that's more long-term. But, again, if we're talking about 2026, that's going to impact your ability to get a refund on time, most likely.
All right, Jordan, got to let you go. Thank you so much for joining us. Appreciate it.
Thanks for having me.
Let's do a final check of the markets here. You're still seeing selling across the board. I do want to mention the tech-heavy NASDAQ in correction territory. You're also seeing chip stocks pairing their earlier gains off of Broadcom's results that were positive, lifting that stock. We then saw a lift of the rest of the tech-heavy names. Now we are seeing the broader NASDAQ slipping again into correction territory, with the semiconductor index now lower on the session, down nearly 24% from the month of August here. Sentiment still weak among some of those AI plays in particular. You've also got Nvidia down a little close to 2.5% this morning, and off the back of that jobs report. Again, nearly at expectations, but we're still seeing selling across the board off the back of a very volatile week for stocks here. Again, that NASDAQ hitting correction territory, down 10% from its previous all-time high. It's going to be it for Wealth. I'm Madison Mills. Thanks so much for watching, and have a great weekend. Also, stay tuned for Market Domination with Julie Hyman and Josh Lipton. That's coming up for you at 3 p.m. Eastern.